Good afternoon, everyone. Welcome to another episode of our Wednesday webinars. My name is Stock Darts, and Frank's not around, but if you like the content, you can follow me at Stock Darts. You can look for extra videos on YouTube at Stock Darts as well, or you can go visit us at patreon.com/StockDarts, where you can find more of my information and my blog posts and trade ideas. As usual, we're going to go ahead and take a look at the four major market ETFs. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish with that, we will take a quick look at the US dollar, see how it's performing, see how it's impacting gold, silver, and oil, and then from there we'll move on to chart requests. If you guys that are in here early have any chart requests, feel free to type it in. Let me know in the chat if it's a name that you already hold or one that you're looking to get into, as that could change my view on it. After all, if you've been in the stock for a week and it's up 20%, and I'm here telling you it's not a good time to get in, it could be a little bit of a difference of opinion if I'm trying to give you advice on closing it out or if it's an entry trigger. Other than that, let's go ahead and get started. We're going to look at the S&P 500 first. And here's a look at SPY, basically throughout 2018. And as you can see, we've been doing pretty well today. Even though we've got a tight action going on here with a really tight doji, the last week has been pretty interesting in the markets in general. And the reason for that being is that we've gotten a pretty big disconnect since last Wednesday's FOMC statement. And the big issue here, of course, is that what we're starting to see now is the small caps really tank and really start to struggle, while the rest of the market has done well, particularly the Dow Jones. And I'm beginning to think that this is a pretty big issue as far as where we can expect the market to go throughout the rest of October. It's looking right now like the selling is basically localized to just the small caps and has not trickled down to the rest of the markets. But if we don't see a change in character soon, I suspect that the rest of the markets will soon start to follow the small caps and start to trade down. The big issue I'm seeing again is that it looks like money is shifting towards the safest names in the Dow Jones in anticipation of further selling. Now, the one thing I do want to point out is that the last time we had a market that had the same sort of nature to it, we still went up, right? If we take a look at what's happened over the course of the last, 3-4 years, and you can see the S&P 500 had a nice climb higher, and then it's traded sideways, and then it of course has been a nice massive rally since the end of 2016. Now, we jump to IWM. You notice IWM sort of in the same place, but IWM was actually trading sideways and losing traction when the market was still climbing at the end of 2014, beginning of 2015. So we've had an environment like this before where IWM has been weak and the markets in general have still continued to climb. Even if we take a look at over here what happened in 2016, IWM was making new lows and really dropping significantly, and the S&P 500 was for the most part trading sideways. So at the moment, not concerned enough with IWM to think that we are in a state where I think it's the end of our bull market or a situation where we need to worry a little bit more than we have to. I think that we're still in a strong environment where buying is the correct option, and what we're looking for is basically for buyable dips, right? So when I talk about the fact that I think the market might start to follow down, I mean it in the short term. I don't mean it in the long term. I'm not even sure I mean it in the intermediate term at the moment. We're just looking at short-term fluctuations and looking for better interest, better and more interesting points to enter on the long side. So that's the one thing I want to make sure that we get across here is when I discuss the markets now over the next half hour or so, anything in general that I say negative about the markets is really in the short term. I think overall in the long term, we have plenty of room to go up and are not in a spot where we need to worry about the market's health. Okay. Now, with the S&P 500, you can see we're actually exploring highs, right? We're very close to all-time highs. We have a nice little short-term trajectory to the upside. We did sort of consolidate and trade sideways. My expectation over the last couple of weeks has been that we trade sideways, and we've done that for the most part, although we've done it with this sort of idea that we keep trying to push higher. But for the most part, we've basically been stagnant over the last couple of weeks in the S&P 500 and I think even in the NASDAQ. And what's likely to happen next is one of two things, right? One is we continue to explore higher. And if we find IWM, if IWM finds a short-term bottom, there's a decent chance that if it starts to move to the upside, some of these other indices will also follow suit. But I think the more likely scenario is that we continue to trade sideways and give IWM a chance to sort of catch its breath and sort of stabilize and likely print a bear flag, which we'll get to in a moment when we get to the IWM and the small caps. But as far as the S&P 500 is concerned, I think the most likely scenario is that we continue to trade sideways. And that's something that's actually occurred over the last couple of weeks, even though there's been a couple of fake outs. Most notably, the big move that we had up on the 20th. And since then, we did pull back, and then we sort of tested the 20-period moving average, tested the short-term trend line, which I don't think is as significant as the 20-period moving average. But we did sort of test and find some support at 290, and then now we're back towards making our way back up towards the upper 290s, the mid 290s, like 292, 293, 294, and see if we could find some pressure here, see if we could sort of push past it towards new highs. If we falter, if the rest of the markets sort of lose traction and follow IWM to the downside, then I suspect that the first line of contention is going to be this trend line and the 20-period moving average. So if we do sort of sell off over the course of the rest of this week and into the start of next week, then I expect us to come back down and test 290. And then the fact that we would have lost this sort of short-term trend means more likely than not, if we test 290, we're going to head a little bit lower and test the 50-period moving average, wherever that may be. Right now, it would be about 287.50, probably closer to 288 if that did occur in the next few days. And that would be about the point where we can look at finding buyers and seeing whether they're really ready to support price action at that point. I think if we do start to hit the 280s, the 287, 286 area, there's a pretty good chance that we come down and test this intermediate term trend line, which sort of marks the ascent that began in March and April of this year. That is a point that probably needs to be tested soon. You can see that over the course of the last 3-4 months now, ever since about July, we haven't really tested the bottom of this channel. And the channel, of course, that I'm pointing out is basically this, right? We've got this green trend line, which is a pretty significant long-term trend line. Then we've got this yellow trend line, which is for the most part the nice uptrend that we've had in the market since March, right? You can see over the last 3 or 4 months, we haven't tested the bottom. We've just been basically riding across the top of it. And just to give a little bit of perspective, we go back to the weekly. You can see exactly what I'm talking about as far as long-term health is concerned on the S&P 500. And you can see that we've sort of flipped from using this as a support to using it as a ceiling. But for the most part, it still has sort of marked the trajectory that we've been in. And the market has continued to climb higher despite the massive volatility that we saw to start the year. And until something changes, we have to assume the market is going to continue trading along this trajectory. All right, so Frank was... Hi, Frank. Glad to see you join us on the iPhone. You'll follow along, I guess. He's out, but he's going to go ahead and try to follow us as best he can on the iPhone. All right, so as you can see on the long-term chart, that green trend line sort of illustrates the fact that we're still in a very bullish environment, and that for the most part, the market still anticipates the price action rising, right? And I think that's important for you to understand as you look at your trades and as you try to figure out what to get into, is that the bias is primarily up, right? So there's not a lot to worry about as far as the market topping out or really significantly dropping. That doesn't mean you should ignore your stops. That doesn't mean you should chase price action higher. We should still make sure that we use sound trading principles when we're looking at entering trades. But what it does mean is that you shouldn't be in a panic anytime that we get some market selling, because for the most part, that selling is going to lead to a good buying opportunity. And I think that's really the key to take away from here. So if we do get selling, I'd actually welcome it. I'm not a fan of what we've done over the last 2 or 3 weeks, which is basically grind our way higher in a very slow manner. This sort of price action does not lead to very good trading opportunities, because what ends up happening is you get a lot of stocks that sort of drift around their highs and don't give us good risk reward opportunities. On top of that, you get a lot of stocks that are overbought and don't give us good opportunities even from a timing perspective. And I've noticed that recently across the board. A lot of the names that I follow, a lot of the trades I've taken, a lot of the trades I've suggested have struggled as they've moved forward. And I've noticed that pattern across the board. And even though the markets continue to sort of try to climb higher, underneath the surface, I'm seeing a lot more weakness. And I think that that's leading us towards a market that's probably due for a little bit more of a correction. And again, by correction, I mean short term, where we just kind of come back and retest some of this ground that needs to be retested, whether it be the 50-pair moving average, the bottom of this channel, or even the highs that we printed back in February, which we broke out and sort of tested once and then kind of made our way backwards or back forwards. And that might be an area around 286 that needs to be tested another time at least. And if it sort of came at the same time as the bottom of this channel, that would be a fantastic buying opportunity, something that I'd be looking for and anticipating, and would be certainly looking to enter a lot of long trades around that point. Now, we look at the NASDAQ, and you'll see it, for the most part, it's very similar to the S&P 500, right? We have some tight price action, little dojis, right around just below all-time highs. We have a different sort of intermediate trend line, but the same sort of idea, where we're just basically trying to grind higher, right? We're above the 20, we're above the 50, so relatively speaking, we have a little bit of strength compared to the S&P 500, because the S&P 500 is, you saw, well, actually no, S&P 500 is well above the 20 period as well. We tested it, but we're actually quite a bit above it. So I'd say for the most part, they're almost identical. Right? We tested the 20, moved past it, the 50 is well below it. The major trend line we need to pay attention to, we're well in front of that as well. There's this big gap again between the longer term trend lines and the price action, showing that we've been grinding higher and not really having any kind of substantial pullbacks or corrections. We are seeing a little bit of erosion in price action as far as this trend is concerned. You can see we started to sort of really violate this trend line consistently, and are at the point right now where we're holding above it, but there's a decent chance that we're going to sort of lose it and fall back again. And this goes back to the same sort of scenarios that I pointed out with the S&P 500. If the market could gain some strength, which is very possible here, right? We tried to fall below this trend line, held, and we spent 3 days sort of trading sideways, building up pressure to sort of break out. So there's a very real possibility that we break out. If we do, then we'll just continue to grind higher, right? If we don't, then we'll lose this trend line and come back and test the 20, possibly the 50, and probably this 182 level. And again, that's the scenario that I favor. I think that would give us better entry opportunities. I know it's sort of a paradox, but I'd rather the market go down now to give us better bullish opportunities than the market to break out. If the market breaks out, then we continue this overbought, stretched out sort of environment where the opportunities are a little bit thinner, because for the most part, we're not getting the risk reward that we want on the names that we're following. But I do want to point out that despite the fact that I suspect that we probably need to pull back here, there is a very real possibility that we break out. And again, even if you take a look at the S&P 500 and see what we've been doing here, we're very close to all-time highs. There's still room to the top of the channel to sort of grind our way higher. We're not really that stretched out. We've had nice trading sideways over the last couple of weeks. So there is the potential for us to break higher. Although I suspect that we trade sideways to down, I don't want to completely ignore the fact that we can break out from here. But if we do, I probably will be participating very lightly. Very similar to what I've done the last couple of weeks. I'll take maybe 2 or 3 trades a week in equities, and sort of just play it by ear and wait for better opportunities. And that's basically what I've been doing recently, and what I will continue to do until we get a more substantial drop and a bigger reset across the board on more of these charts. Now, if we look at the Dow Jones, you'll notice the Dow Jones is in a completely different area here, right? Broke out, new all-time highs, gapped up significantly higher today. Yesterday was a nice bullish engulfing candle on the previous doji. And so this is what it looks like if the market breaks out tomorrow. Well, if I say if the S&P 500 and the NASDAQ follow suit, they'll go here. Now again, this is a pretty strong disconnect in the markets. We see the S&P 500 and the NASDAQ trading sideways, grinding, trying to build up momentum to push higher, and we've got the Dow Jones on a runaway gap. Past the top of the channel, it broke past the top of the channel. Very similar. Now you'll notice also the relative strength here. In the long term, we never really violated this green trend line, which shows the trend or the rally that we've had since the end of 2016. Very similar to this S&P 500 and the NASDAQ, you'll notice this gap, as we haven't really tested support in a while. We're just sort of grinding higher. And we had to break above the retest, and now we're continuing to sort of climb higher. This is a complete contrast to the next chart, which is IWM, which, as you can see, is falling down, right? So we'll get to IWM in a second. I just do want to point out that there's a pretty major disconnect here between the four market indices. The S&P 500 and the NASDAQ are sort of the blend, and they're in the middle. You've got the Dow Jones leading to the upside, and then you've got the small caps breaking down to the downside. When you have a market that's this disconnected, you typically see sideways price action, which is part of the reason why I've expected the market to grind sideways, is because we have a market at odds with itself. That being said, really, for the moment, most of the weakness, the real strong weakness, has been isolated to just the small caps. So there is the chance that the S&P 500 and the NASDAQ follow the Dow Jones and start trying to grind their way higher, and we just see that the small caps and IWM just sort of try to maintain a sideways price action. And if that is the case, then likely what's going to happen next with the Dow Jones is it's going to sort of maybe try to push another day upwards while the other two break higher, and then grind sideways and have to retest this channel that should now become a floor as we continue to try to maintain this trajectory. I don't think this is sustainable in the long term. Typically, when you have a channel and you grind to the top of it, you will lose that pretty quickly. And then again, that doesn't mean that the Dow Jones is going to top out. It just means that it's going to have to make a more substantial base and trade sideways for a bit longer. And I think, again, that leads towards what I think is more likely to happen, which is that in the next couple of days, maybe we make another candle higher. But I think, in general, what I expect out of the Dow Jones in the next couple of weeks is probably something like this, where we trade sideways and give the small caps a chance to sort of get their act together and see if they could rejoin the other indices as they try to push towards highs. Even if we have a strong pullback, if the S&P 500 and the NASDAQ trade down to those support levels that I was looking at, I don't expect the Dow Jones to really follow suit. I expect it to stay above its 20-period moving average, certainly above its 50, and most likely well above this 263 area. But I think that this is probably the area that we can expect the Dow Jones to trade as long as it doesn't continue running straight up. If it trades sideways or down, I expect it to trade first to test this ascending trend line, and then to follow down here and maybe trade down to the 263 area. Now again, that's mostly theoretical, but that would be what I would anticipate, and that would be the scenario that I would look at first when I'm looking at how I want to react to the markets. And then finally, we have IWM. And of course, IWM, totally different picture here, right? Much, much weaker. You can see we lost our support at 169, which it looked like we were going to lose on Wednesday of last week with FOMC. It actually, I think, fell down on Thursday. And then we tried to make our way back above the 50, failed, and came back down, and are right back where we spent most of the summer in. Now, this is not necessarily a death blow to IWM or to the markets. It's not nice to see us fall back and sort of lose an attempted breakout or attempted next stair step. You'll notice, what was this? All right, let me get rid of that, whatever that line. Whoa. All right, give me a second. I don't understand why all of a sudden it started randomly drawing extra trend lines for me. All right, we want to go over here. Okay, there we go. So you notice we've been stair-stepping higher, and this is a failed step, right? And that's typically not what you want to see. So a definite sign of weakness, and I would say this is actually, you can take this as a warning signal on the overall markets. I would not argue with you or debate and say, no, this is still a perfect picture of health. This is clearly a sign of weakness in the overall markets. Now, it's just one isolated sign of weakness, so I'm not at this point ready to impugn the entire markets based off of this, but I think that this is a negative that needs to be dealt with, and we need to see how this resolves in the near future. Now, it was relatively strong to the markets. It was leading the way higher, and now we've sort of lost ground, and I think the question becomes, is this money rotating to safety while we wait for sideways action, or is this the first sign of real selling pressure in the markets? And we really don't know that yet. But I suspect that this is really more of money rotating to safety as they anticipate weakness or softness in the markets, but not necessarily, everyone running for the exits and getting ready for a bear market or anything of that nature. I don't think that's where we are right now. I think this is just money flowing to safety after it took advantage of a pretty strong rally. So for now, we're going to look at it at face value and just assume it's money rotating. And if this continues to act poorly, if we get below the 200 period, then we have to start to reassess what we're thinking of the markets. But for now, my opinion is that we are going to sort of turn sideways and stay within this box, right? And for the most part, hopefully the upper half of the box. You can see we had a pretty strong day today so far. We're up 1%. It's a nice candle, and ideally, what we're going to do next is come up and test the 50 and the 50 and the 20 pair moving average. Can we push past it? Probably not. But if we can do this in the next couple of days and sort of hold in that area, then that would be a good first step towards trying to make our way back above 170. But I think it's going to be a while before IWM gets above 170. Like I said, I think the markets are more likely to trade sideways, and I think the key for IWM is to stay somewhere in this area rather than to start doing something like this. And if that's the case, then we could be in a little bit more troubles, particularly if we start to fall below the 200 and fall below this. If we lose this entire base, that's a real negative. And at that point, I would be more likely to want to reassess my opinion of the markets and start looking at maybe reining in risk and being a little bit more conservative. But for now, I don't think we're there yet. This is just sort of conjecture. I think for now, as long as IWM stays somewhere between 170 and the low that we printed yesterday, then I think that we're still in a market that wants to trade sideways and has the potential to sort of just stabilize and wait for a better point to try to rally as we close out the year. Again, we've got basically 3 months to go. My anticipation has been that we would have trouble in October, but once we get into November, December, I think there's a decent chance that we can have a nice rally. And we'll see how we navigate the rest of this month. But my anticipation from here next Wednesday is that we trade sideways and try to give IWM a little bit of time to sort of get its act together. Okay. All right. So since I've been going over the markets, we've had a lot of people sort of check in. So I just want to point out again, if anyone has a chart request, feel free to type them in. I'm going to look at the US dollar now. We're going to look at oil, gold, and silver. There's not really a lot to discuss with them. So we should have plenty of time for your guys' charts. Let me know if it's a trade that you are looking to get into or if it's one that you're already in, as that could really change how I look at or how I interpret the chart. Let's go ahead and take a look at the US dollar. And the US dollar has picked up a lot of strength over the last week. Now, I think this is nice. This is actually something that probably should have been expected considering rates going up. And a big portion of this is that the US dollar actually finally got some traction against the euro. You can see the euro lost a lot of ground here. Came all the way back down to 115 after trying to establish a bullish breakout. And has now come down to a pretty key support area. I anticipate that the euro will gain some traction here and that the US dollar will stall out. That's likely what you would expect when you look at the UUP chart as well. We've kind of come up pretty strongly and are now probably going to have to stall out, even though we did break past this ascending trend line. But we're at a pretty key area here where we could stall out. And I think that's what we're going to see on the Euro USD chart is, again, the euro should gain some traction here. At the very least, print a bear flag before it tries to break down again. Now, if we look at the US dollar versus the yen, it's had a strong, strong move. I'm hoping some of you guys, there's a few of you guys here that are Patreon subscribers. Most of you by now hopefully know about my Patreon page. It's patreon.com/stockdarts. We had a free trade. I posted a free trade on the on the US dollar yen on the 17th, right? So over here, when it was trading at 111.8. It's gone up over 200 pips since then. And I'm hoping someone else took this trade. It's been a very clear trade. I think it's got 115 in its sights. We took some profits at 113, which is a key area, but it's continued to move very strongly upwards. And I think this, again, is a very nice sign, not only of U.S. dollar strength, but Japanese yen weakness. I don't know how many of you guys are Forex traders, but this is trading Forex, trading cryptocurrencies, just broadening my horizons, allows me to be more picky when the market's not giving me a good trade, right? So right now, as I told you, I'm not happy with where the market is, even though we're pretty much at all-time highs on most of the major indices. The price action is not that great, right? But because I'm able to look at other equities or other asset classes, I'm able to sort of be picky with the stock market because I can find trades in other instruments or other areas that are doing well. And this is one that's done really well for me and has kept me from having to try to force the issue with the stock market because I find other ways of taking advantage of trading. And once you really understand technical analysis, you could trade pretty much anything that has a chart like this. And for now, this has done really well for us. And hopefully, as I said, hopefully some of you guys that read my Patreon page hopefully took this trade because it's paid off very, very well. Now you'll notice the U.S. dollar has gained a lot of strength versus the yen and versus the euro, but it's actually lost a lot of ground versus the Canadian dollar, right? And this is a function of how strong oil has been, which we'll get to in a second. We've actually dropped. We're back to the bottom of this channel. I think, again, this looks like very interesting in that the U.S. dollar looks like it needs to stall out versus the yen and versus the euro, but it looks like it needs to gain some strength versus the Canadian. And so if you're someone that wants to trade the U.S. dollar, this might be the next one to look at, but I probably would stay away for now because you're trading noise at the moment. It's in a channel. It's not quite at the bottom of the channel. We've got a lot of potential resistance, and I suspect that if we do bounce, it's going to be short-lived up to 128, 129. And right now is the weakest of the currency crosses with the U.S. dollar that we watch. And again, I think a lot of that has to do with the fact that if you look at oil, oil has been incredibly strong. It broke past 75. If you're someone that has a long commute to work or you're someone that has a big SUV or a truck or something, you're not happy with this. Gas prices are definitely going up. This is opening the door right now for $80 oil. I don't want to see that. I don't think anyone really wants to see that. But I think that if oil builds off of this strong action and extends a breakout, that might start to get to the point where we worry about it with the markets in general. Ideally, we stall out here at 75. If you look at it long term, once we break past this area, there's like a price vacuum all the way up to 90. And if we get to that, uh, that's actually a lot of trouble. I think that's going to put a big dent on the bottom line of a lot of companies and a lot of industries. Um, Ideally, what we should be seeing here is a stair step, and if that's the case, we should see price stay between 73 to 53. But as you can see, we're starting to push past that, right? And if that breakout holds, then that's gonna put a lot of pressure on a lot of industries and a lot of consumers, right? So I don't really want to see that, but for now, this is another area, right? So um, as I mentioned, small caps are doing pretty poorly, right? And there are still areas that are doing well. The Dow Jones, if you're looking at trade stocks, Dow Jones names are one of the areas you want to look at. Oil names are an area you want to look at. And Mike, interestingly enough, your chart request is on oil, so we could probably look at that now. Um, Once we get through, well, I'll look at gold, silver real quick, and then we'll jump right back to SCO um, and see what you want to do with that. So, as you can see, oil is very strong. And printing a bull flag, right? So it looks like it wants to try to have a run at continuing and breaking past these levels. If you look at gold and silver, and they're sort of, the one interesting thing is the US dollar has rallied, and gold and silver have sort of made their way higher, but they're still basically just trading below major support. And I think, again, this is not an area that I'm interested in at all. I think that there is a long way to go before they get back to a point where we could trust them to the long side. When you have an equity trading at the levels that it's trading below such important levels of support, there's so much more downside risk than upside risk. It's easy to look at this and say, well, it's depressed, it's at a good value, but the truth is there's so much more risk for downside gaps overnight on equities that are below such major levels in the long term. And as long as that's the case, you can't really trade these with any sort of trust, and particularly a name like this, something like gold or silver that trades overnight. So for now, I'm off of these, and I really don't have any interest in them at all. All right, so let's look at SCO. Again, anyone else that has a chart, I'd love to see what you guys are looking at. Maybe you found some names that are doing better than the ones I'm looking at. All right, so this is the ultra short, right? So this trades inverse to oil, making new lows. You're thinking of SCO calls, thinking oil fades some. Okay. So what we're going to do here is we don't need to do technical analysis on this, right? Because it's basically just going to be the opposite of CL. So we're going to look at CL, and then we're just going to interpret it from that perspective, right? So let's go back to oil. So here's my thinking. Right, we're going to draw. Okay, so it's printing a flag right now, right? If you're buying calls, now it's a little bit tricky, Mike, because oil trades overnight, right? So there's a decent chance that you want to, when you're trading stuff like oil, gold, silver, anything that trades on a 24-hour market cycle, it's sometimes the moves happen after hours, and so if you're trading with options, there's a chance that this thing gaps down, and if you were waiting for a technical break, you don't get it, right? Because a lot of times these big moves. Let's say, for instance, that you were doing the same thing back here, right, where you wanted to go ahead and play oil to the downside. sometimes these big moves happen overnight, and by the time you wake up or by the time the market opens, you sit here down here trying to buy your SCO calls, and it's probably too late. So sometimes trading these instruments, you have to do it. You have to anticipate and get in early, right? And that could be a problem when you're trading options, because if you try to anticipate, sometimes these things get stuck for 2 or 3, 4 days, 5 days, a week, and you lose value waiting for the move to happen, right? So there's that consideration. That being said, I am of the opinion that at the moment we probably want to wait a little bit longer before we go ahead and short oil. I want to see how this resolves. Right now, this looks bullish. I would like it to fade here, and so emotionally, my thinking is that this probably needs to come back down and test 71. But the truth is, if I look at this objectively, right now price is holding above the previous highs as it flags, and looks like it wants to go higher. So what I do, if I were you, if you're looking to get into some SEO calls, what you might want to do is start light. Maybe if you're really gung ho on shorting oil, maybe buy a couple. I don't know how many you're going to trade in total, but maybe you start with a really small position and anticipate, just in case that this thing just for whatever reason really comes down. But I would wait for the major part of your trade. I'd give this another day or two to see if this turns out to be a bull flag or if it turns out to be a quick top and then it starts to trade back down. Judging by the price action we're seeing today and how quickly it sort of came back up after hammering, I think that there's still buyers here. And I think that this is in the process of trading, building a flag like this, right? So until we see that flag erode, I don't want you to hold too many calls and watch them lose value. I think that there's a decent chance that this is going to stall out for at least another day or two. And then from there, we'll get a better picture whether this is going to roll over, whether it's going to try to break out and make a run for the 80s. So that's what I'd do if I were you. Maybe get a couple, because again, if an overnight move happens, you may not have the ability to get in after the fact, right? So if you want to start early, go ahead. But I think that this is probably still a few more days away before we get any real strong move to the downside. Yeah, I would. Yeah, no problem, Mike. And yeah, you're probably early, but again, you never know. But I would say you're probably a little early. But I do think that, or hope that would be a good trade to take, because I'm of the opinion also that I don't think we're ready to sustain price above the 80s. So I would like to see a pullback here as well. All right, Ron. CBAY Therapeutics, CBAY. I've never seen this one before. It looks like a channel to trade thoughts. That does look like a pretty nice channel. Let's look at the weekly chart first. All right, that's pretty good support. We've got a little bit of a... All right, so... yeah, it looks pretty good from the weekly. I like what I'm seeing. All right, I like this. The only thing I don't like about this is it's already at 11:52, and the top of the channel is 15, right? So that's still 350 of upside, which is good. But there's a pretty decent chance that it stalls out here at 13, which is only about $1.50, right? And we've got about $1.50 of downside, or about $1.30 or $1.20 down here to about 10.20, 10.10, depending on where you want to stop out. I do like this, and I think that this looks like a good bottom. I like that hammer. The volume's not really there, but I like it. Did find some good support here. I think the risk reward depends on whether you're anticipating a move to 13 or whether you're anticipating a move to 15. Maybe if it does something like this, it comes down closer to the the 1050, 1090, 1080 range. Maybe we could look at it as a trying to get it off of that. Yeah, I don't know. I think it's okay. I just don't think the risk reward's great here. I don't know if this is I don't know if this is a long term thing you're looking at. It's probably not, because you're looking at just trading the channel. It looks like we might have missed an opportunity, honestly, with the channel. But it would have been difficult because of yesterday's candle was pretty long, right? So an entry would have still been at 11, which is, I mean, it's 50 cents away, which is a pretty decent amount on an $11 stock. But I do think that it found good support. I like the channel. I like everything about this except for the risk reward right now, especially because I think 13 and change is going to be the point where that would be the target, at least for me at the moment, more than 15. But it looks like something that maybe we would have missed. But it maybe gives another opportunity if it comes back and retests and then finds a way of sort of trading higher. But this is one you could put on a watch list also. And in a couple of months, once it starts to challenge this descending trend line, it might be worth a good move. Like, this is the kind of trade where right now it looks good, or it looks okay, but there's a decent chance that in another couple of months, this gives us a really good trade. So I would keep this on your watch list. And I think it's okay to try to trade here, but I don't think that the reward is really there right now for the risk. But it could be dependent on how it behaves in the next couple of days. And again, even here, it's still about 2 to 1, so it's acceptable. And if you wanted to be real tight about your risk and say, well, I don't want it to fall back below 11, then you still have a trade here that you could take, right? But just understand that it's going to have to work through a lot of stuff to get to 13, so this will be a little bit of a slower mover. All right, a couple of China companies. Here's JD. I was looking at JD recently. Here's a weekly. And you'll notice, last time we looked at JD, I can't remember if this was with someone or just by myself, but this dotted line represents a pretty key area on it, because that was when it broke this descending trend line. There was a lot of buildup and anticipation, and once it broke past this level, it really exploded, right? And then ultimately, it formed this big, almost like a head and shoulders at 38, and ultimately failed, and has since then lost that entire move, right? And it's right back to that big breakout area, and you can see it broke down below it, found buying, and is really struggling with that area. This is a key price point, in my opinion. Now, it could be there. It could be down here. We can actually say the key area is this, right? That big buildup of price right there. And then once it broke out, but we'll go with the support zone around 25.60, right? It's still struggling here. And ideally, we're not even going to use that trend line anymore. We're going to go to this. This needs to, we need resolution here. I can't even, I guess this, it's like a wedge, right? If JD could get to this, then I think it's worth a long play. I think this could be a nice bottom play with a move that could make its way all the way. I mean, this could be a 10-point move. Now, granted, that's a longer term play, as in this wouldn't take place over the course of a week or two. This could take several months and even a year, or through an earnings cycle or two. But there is potential for a lot of upside, and I think that the key is if it can get above here. If it can get above here, then you have a pretty good trade idea, and then you have a pretty clear stop, and you have a lot of room for upside. At least, I mean, at the very least, you could say to 28, and then to 31, and then to 34, and then finally 38. Right. So you've got 3 or 4 stages of targets that you could look at on that. So I think that's pretty clear cut what I'd see out of what I'd want to see out of it. And the first thing is it needs to clear this glut of selling and get back above that previous breakout zone, which again is between it's about 25.60 to 26. So if you wanted to be safe and be clear, you can say anything above 26 to 26.20. But anything in this area here would be pretty decent for it. Okay. The other one is Alibaba. And this one is not quite, it's interesting because it hasn't broken down as badly as what we saw in JD, but it's below a pretty important level. Right. This is what we were discussing with gold and silver, where when you have an equity below a really key support zone, there's a lot more potential for downside risk and for ugly surprises. What we have right now is ultimately kind of a bear flag, where you had the big move down, and then you have this consolidation below support. This is probably going to resolve to the downside. I think this one, I'd want to see it here before I really wanted to trade it, right? So I'd be more careful with this one. But if it was on this side of all this mess, then I think it's worth a play, because this could end up being a false breakdown, and then again, massive upside once it's here. But I don't think it's here yet, and I think there's a pretty good chance this resolves to the downside before it really breaks past this. But if it can break past all of this, the 50 period, this descending trend line, the 166.50 area, and hold, well, it doesn't really need to hold this. It just needs to be above all of the rest of the stuff. Then I think it's good. But for now, I would probably stay away from this because there's more downside risk. There's more chances of a surprise to the downside than there is of a surprise to the upside. So it's coming. There's a chance, but you would be early here. Okay. All right. Now, other RON, you're looking at EA. Now, look at the interesting thing here is, again, for those of you that are Patreon subscribers, we had 2 trades on video game companies recently, or trade ideas anyway. One was Activision, which has done pretty well, right? In anticipation of some big releases in October. This one's doing pretty well, and then we have Take-Two, which is sort of struggling, but still building up pressure. Notice the difference between what these two are doing with what EA is doing. Right? There's not a lot of build-up or anticipated build-up for EA's releases into the holidays. Now, does that mean there's no trade here? Not necessarily, but I did want to point that out, because that's something that I wanted to show, is that there are other companies that are doing much better than these guys. That being said, we do have nice potential trade here, as far as finding a bottoming pattern here. This is actually a pretty key level. We go back to the weekly chart. Just delete this trend line. And you can see we lost an ascending trend line. That doesn't always, whenever you lose these trend lines, it doesn't mean it's the end of the world. It doesn't mean you're going to top out. You'll notice the last time we lost an ascending trend line, it just based out for a bit longer and then eventually broke out, right? So this happens. It's normal. That being said, this one, a little bit more substantial of a break. It is trying to hold above 115, which is key. And I think at the moment, there is a potential trade here all the way up to 128. So there's about 10 to 13 points of upside based off of where we are right now, which is pretty good, right? So in the end, could even give us more points than we would get on some of the stronger names. If I were targeting this, this is about what I'd be looking at. Again, because it's weaker and in a weaker spot than what I'm seeing out of the other names, I'm not looking for highs. That being said, Not sure if you're going to trade this with options, you're going to trade this with stock, but this is one that you can look at. If it clears these two little tweezers, these two little dojis that are forming, it gets above 118 or so, we can look at a trade up to 120 and then all the way up to 125. And then we can look at maybe holding for an earnings gap into November. Let's see when they report. Earnings season's coming up pretty quickly again, by the way, folks. So it's time to start paying attention to when these companies report, because it's going to have an impact on your possible trades on them. All right, so October 30th. So we got about a month. So we got plenty of time on this. And so from here to October, it could certainly hit 125 and maybe even try to get above the 200-period moving average. I like what it did here. We had a big drop, a bear flag that eventually turned into a base and then resolved to the upside. A lot of times you get strong moves out of failed patterns, and I would say this is a failed bear flag. And what we want to see now is for this 115 to confirm a support, and we've got potential. We've got 3 days in a row of long wicks. So all we need is a strong close today or a green candle, and I think we've got to trade to at least 121 and hopefully all the way up to 125. So I do think that this is a decent play, Ron, despite the fact that I led with pointing to other video game companies that are stronger than this one. I think this one does set up for a decent trade with a pretty clear stop out. And I think that there's a potential for gap fill, maybe up to 127, but at the very least up to 125. I would not expect anything beyond that until earnings. And then even then, I don't anticipate a great earnings guidance call based off of what I'm seeing out of them. But you know, that's veering towards more fundamental and theoretical stuff, which I try to stay away from during these webinars. For the most part, I try to stick to technical analysis of my trades. That being said, I do pay a lot of attention to the video game industry, so it is something that I pay more attention to and I have a little bit better feel for. And Activision is in a much better place as far as the Call of Duty expected sales versus Battlefield, which is the big EA launch that's coming up in November. All right, so I think that's it for today. I want to thank you guys that participated. I want to thank everyone again that's joining. If you have not visited us on Patreon.com, I highly suggest you do. There's a lot of free trade ideas. Even the subscription is only $8 a month. All it takes is one trade to probably pay for a year, if not more. And you get a lot more access, not only to trade ideas, but to technical analysis, like a window into how to analyze stocks from a technical perspective, which I think is worth more than just trade ideas. So I hope you guys are getting value out of that. Those of you that are already members, I'd love to get some feedback if the content is helping you, if you're taking those trades, or if it's just helping you in interpreting and understanding how trades work. Other than that, I hope you guys have a good rest of today. And we'll see each other next Wednesday.